Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities. My name is Ryan,
My name is Lucas.
and we have another installment of our macro outlook series. We are going to take a look at some current events, some price action, and some bigger picture stuff with a look to the future. Before we jump into that, I want to kind of run through some of our playlists because we do a lot of time and energy goes into these, and it's awesome what Lucas and myself have discovered and we want to share with you. So we've got some playlists on how to start your secret journey, how to get your Keppel.
Resources.
Oh yeah, resources.
We call them free sources. They're free resources
Resources.
for you. We got playlists built out. How to start your secret crypto journey. Start with the Kepler wallet. So if you're new to DeFi, new to crypto, and you'd like to get started, we've got tutorials. We actually walk you through live action, and we've got a DeFi tutorial playlist where we actually do it live so you can see exactly how it works. And when you do it yourself, we've got secret NFT playlist because secret NFTs have gotten a lot of attention, as you know, or maybe you don't, but they are all over the news as being a great expression and innovation and decentralized blockchain security. However, on a public ledger, they're limited, and Secret Network has a whole other use case and dynamic. So we've got special playlist on that and so much other amazing protocols, Alter Mail, Jackal DAO, Shade, Silk. So
Right.
just a whole myriad of amazing protocols being developed on Secret that you just can't build on other networks. So yeah, check out these playlists. We've got some airdrops, opportunities, whatever happens in the markets. One thing that we learned from the 2017 ICO and beyond is that participation is key to maximizing the growth and the rewards, returns that you can get in the space. And it's also when the markets are consolidating or correcting or going down, whether it's for a few months or a year or so, that's still when you can find out the teams that are worth their salt, that are developing, that are there, and you can really find the most valuable up and coming projects. So
That's right.
knowledge is power, and we hope in some medium to continue to be able to regularly share this info and the importance of the latest developments, especially with this macro outlook. And Ryan's, you pulled together some pretty cool, a really neat article that we're going to get into. And of course, we're going to look at the market to look at what's going on, why the price is doing what they're doing today, and what can we expect to see over the next few months so that we can better prepare ourselves and be ready. If you know it's going to rain and it's going to storm when it comes and hits, you're not worried and freaking
You're not
out.
surprised. Yeah.
You can get out of it if you want, or you can stand out and say, I don't mind getting wet. I'll wait till the sun comes back and I'll dry out in the sun. Everyone can has their own.
Well, it's been a sunny day. Speaking of the sun,
beautiful.
Lots of green in the markets today. I know I woke up and spent the morning with a big smile on my face, being a fan and a member and an enthusiast of the IBC, seeing Juno and Secret and Cosmos all doing very well. So that was a great to see. And of course, Avalanche is, really hitting it hard today with 12%. That's, so all kinds of good stuff broadly across the market. I mean, there's a little bit of small pullback, profit taking in the last hour, but, broadly for the day, lots of green candles abound, right? And if you look at the mainstream financial traditional markets, it's the same story. And one thing we like to hit on is that these things are correlated, right? It's not an accident that they're all both going, that broadly these spaces are rallying at the same time. There is seems to be a inverse relationship between the dollar index, you would say, and the financial assets in general, such that when the dollar is broadly weakening, you see financial assets doing good, and when you see the dollar strengthening and interest rates going up, that tends to be negative for financial prices, market prices. So just this general understanding can be helpful. But moving on, so what are we attributing this to today? Because it's not like we got any new news from the Fed or on inflation that was positive or anything of that sort.
Let's talk about where we just were. And we did a video on where we just were. So what we're just coming from is a correction, some red times in the market. And that's because news came out that, inflation
higher than we expected.
7.5, another, 50 basis point, 0.5% higher than we expected from our measurements. Who knows how bad it really is? And the market responded with, okay, well, if they're talking about raising rates and having to make some changes, and the inflation rate's already higher than they expected, that means the belt is about to tighten quick.
Right.
And when we just did a video on that, so the market kind of came down. After that, though, now, and you had a great point before the video, because there are so many things happening. It's a very complex, and we're just sharing. There are many things happening in black swans, stuff affecting that we are not aware of. This
Oh,
is
yes.
this is not every variable in the model, right? These are just major
Major
influence,
components, essential
major components
components.
that we see at the moment. And please drop in the comments what you see as well. But you're mentioning that right now, there's some major geopolitical news came out that really relieved the market and released tension.
Yeah, that's right. And I think this is really what's driving what's happening today in the markets. What explains the optimism and in the green candles. So there's been an easing of tensions. I'm sure everybody's familiar with the drumbeat, the march to war that we feel like we've been on these last few weeks with the situation between Russia and Ukraine. But there's been some good news that there's word that the troops that have been engaging in drills and exercises in Ukraine, or near Ukraine rather, are going to be pulled back and withdrawn. So that eases tensions. And there's also a indication that Putin says he will continue discussions, or he sees room for continuing discussions and diplomatic engagement with the West. So these are both very good signs that we can maybe get past this event without hostilities. And it's definitely a reduction in the tensions. I would say that.
That's good news, because this is the 21st century. They all seem like very intelligent, men that have, a good understanding and cultured. And, I think there's a way to communicate. Isn't Russia, I heard, did not Russia and Putin come out and talk about paving the way to innovation and being another one of the forerunners in adopting crypto and blockchain?
Yeah, I think they've been somewhat supportive in a sense. Yes.
So there's so much innovation happening worldwide for people to embrace and to focus on, that can bring a lot of harmony. And it's on a decentralized. It's breaking the mold. Instead of this boundary mentality, we have these new technologies that are able to secure networks, add value, bringing people together worldwide. So that's a beautiful thing. So
this is definitely good news, right? And it makes sense why markets would rally, including crypto markets as well. Mm-hmm. But we started this whole thing off because of some other good news, really. And I don't know if you could read this quite as good news, but it's definitely can be. I put it in that category because it's more like long-term good news, I guess you could say. But what we're seeing here is there's some price action. And traders are signaling through prices that they don't anticipate the Fed to be able to continue and to really hit the goals, essentially, to put it in a real clear way. They don't think that they're going to be able to live up to their promise of a 250 basis point rate hike, which is essentially 2.5%. And they believe that they will fall short of that. They estimate that it'll be around 2023, the middle or the end, when we will start to see the next round of rate cuts, return to easing, a turn to accommodative, stimulative monetary policy, right? So let's talk about this and what it means. First of all, I'd say it jives, not to pat our channel on the back or anything, but this does jive with what we've been saying this whole time about the limits to monetary policy and how a rate hike can only really go so far and so high, and how the pain will be pronounced from that, and how this will induce a reversal quicker than what people are expecting. That's been our narrative. We have given various reasons for it. We can talk about that here too today later on, but just to kind of make that clear, where our position's at.
And it's from our research, and it's not from reading tea leaves. And there are other people that we can point to that are expressing this understanding as well. So it's just about knowing where to look and do your own research. In fact, nothing we say is financial information, legal, commercial advice.
No.
It's just educational entertainment. It's our sharing. It's us sharing our passion for economics and markets. That's where we met. Our background is in studying this. And also we enjoy the innovations and what's going on with blockchain and crypto and sharing our research there. So
Right.
absolutely, we make mistakes and learn from them. And there are other things happening. So take this all with a grain of whatever you like.
Big grain.
A grain. Yeah.
All right, so let's jump into this article. And what are we reading? What are the prices? What's the price action telling us? And what in the world does this mean? Well, so we're looking at the Eurodollar market here, right? So this is the Euro bonds, and this is dealing with. But broadly, these things are correlated, right? It's a global market. Monetary policy authorities coordinate their actions. You know, there's a lot of coordination between the Euro and the West and the Bank of England and the Fed. So this is looking at the Eurodollar market. Just starting off, we're going to move into the Federal Reserve and the Treasury bonds in a minute. But right now, what we're seeing is that there's a negative spread between the 1 year and the 3 year Euro bond, Eurodollar futures. So what this means is that the yield or the return for holding a 1 year bond is actually greater than what it is for the 3 year bond. And that's very much backward or inverted, because normally the longer out in the curve you go, the higher the yield, right? The longer you give up your resources, the greater the time value of money of the loss, right? Of what you're doing without. And so there's a compensation in higher interest rates, a higher yield. But in this case, we're noting that this is not playing out in the way you would expect. And in fact, there's actually a greater yield in holding a 1 year debt instrument versus a 3 year. And so this is really telling a big signal. And what that signal is that the market participants are pricing in a rate decrease, right? They're seeing a right. We think there's going to be this many rate hikes moving into the 2023, right? They're pricing in 3 rate hikes, but what this negative relationship, this inverted yield curve relationship, what this is telling is that the market participants believe there's going to be a rate decrease between 23 and 25. Right. That's how you get a negative, this negative relationship. So the way it works is that interest rates are predicted to be reduced during this period, such that the difference will be lower than what it is in December of 23. That's how you get a negative relationship.
Before you get that reduction in December 23, which is a year away, we're looking at the news today, and the news today is saying we are about to start pumping up the rates. We're about to start pumping the rates, which correlate, which makes sense what you're saying. So if we're going to start, doing 25 basis points, 50 basis points, let's go up 200 basis points by the middle of 2023. Okay, fine. But starting 2023, it's going to start having to taper and cut.
Right.
And we'll talk about whether or not it makes it that far and how.
That's right. Yeah, that's a good question. So the Fed is projecting that their median forecast, there's a plot, there's a dot plot that's basically it's a survey of the different members, and they come up with a median forecast, and that average or median baseline forecast is looking at around 2.5% rate hike, or 250 basis points over the course of this cycle, and this is expected to this is thought to be. I'm sorry, let me reword this. And further than that, the president of the St. Louis Fed, President Bullard, he'd like to see this 100%, so 1% rate hike or 100 basis point rate hike by July. So that's pretty quick. That's a pretty fast timeline. And so the question is will they hit that? Will we get to this 250 basis points? According to this, the thinking is probably not. Is that will probably not hit that, maybe even hit 200 be the peak. And so the question is, does the Fed have the will to follow? This is really a question of will. Do they have the will to follow through with what they're saying, given what we expect to be the negative consequences, right? You can look back, and the last time they tried this to normalize rates and to reduce their balance sheet, it had a pretty negative impact on the markets. And it wasn't long before the political discussion centered squarely on the Fed and how they were going to cause a recession because they were holding rates too high and they needed to lower rates. And so the political discussion led quickly to a change in policy. It wasn't that long before you saw a return to QE, right? And this was a large part of what kind of brought the Bitcoin crypto space back into a bull market after the great sell-off that we had gone through in 17. So the point being is that how high they can go and how long they can sustain that with all the pain that's going to follow, that's really a good question. And the thinking is that the Fed probably won't be able to. I mean, the smart money says they're not going to be able to do what they say, and that there's going to be a quicker timeline to when we go back to easing and cutting rates.
Quicker being 2023.
Right.
And what that means is we haven't even seen one rate hike yet. So let's remind everyone that to be ready for a year, at least a year of what's expected, what is everyone's expecting and agreeing to be a buckling up and a raising of rates, and some changes are to come. And when that happens, it very well may be a consolidation period in the crypto market as well. There's a very good chance of that. So I would say be ready for the possibility of a year or so of maybe some sporadic growth and pumps here and there, but for the most part, probably a lot of deleveraging in the markets in general. Because
we don't give financial advice, but it wouldn't be too extreme. I wouldn't be surprised. Let's put it this way. I would not be shocked if somebody, if in 6 months or 8 months from now, we look back on this February day and say, wow, that would have been a great time to take profit. That was like a local peak.
Yeah.
You know what I mean?
Right.
You easily, not a permanent peak. I think, but a local peak,
right.
Easily.
At least from 6 months away. I think
6 months away.
6 months from now, there's going to be some deleveraging and some bleeding out in the markets. There's going to be some reactions felt worldwide as these rates start coming up, period.
It's really hard to see it any other way.
Now if there's some major decoupling, and this is the year where we just start seeing crypto markets just explode and pump,
right,
while the rest of the economy and the US market is going through, we'll learn and educate, and we'll be educated, and we'll learn about that, and we'll talk about it together. But from what we see at the moment, I would say it might be just be prepared. Let's say proper planning prevents
poor performance. Yeah. You know what I was gonna say? It's an aside.
Oh yeah, hope for the best, plan for the worst too.
That's the other one. Yeah, it's an aside, but I think it's ironic that it seems like, if you would have taken a poll but last week, were we going to go to war with Russia? Is this going to happen? Is there going to be an invasion of Ukraine? I think many people would have said yes, right? It was definitely, especially the media. If you were following the media, that was definitely the narrative that was being sold. And now a few days later, we're seeing, well, maybe not. Maybe that's not going to happen. As much as it looked like that was what was going to happen, maybe not. And I find that to be ironic that it's coming on, that the timing is ironic in my mind, because we're entering into a global, not just the US, but globally, we're entering into a rate hike tightening phase in monetary policy.
And what's often done to help relieve depressions and recessions? War.
Well, not only that, what finances war? Easy money policies.
Yeah.
How attractive are global easy money policies when you're already trying to go into the opposite? We've already had a decade of that, and inflation's ripping out of control. Do you really want to do that again? Double down on that policy, create more money, lower rates, finance this massive expenditure? I feel like that's something you do, what you were saying, when you're coming out of a recession, when you want to stimulate, but we're at the other point of it. We're at the point where
And
where it's been inflated.
I think it might just, I don't watch TV on time. So I don't, this is just speaking from not knowing what's going on in the world in the news and what's just doesn't make sense to me. The 21st century, all the pictures I've seen of Putin and people I know that are Russian, very, very chill, cool, laid back. I mean,
Right.
innovative, good at chess.
Well, I think you could say
Tchaikovsky, good music.
I think that's a good. I mean, you could say that about any time. I mean, look at Germany and Austria. Look at Austria.
No, that wasn't the
prior to World War II. You know,
I can't say that was the 21st century. I said we're living in the 21st century, man. Come on,
right.
We're talking on this thing called a Zoom.
That's true.
Yeah,
we got flying cars, squirrel suits with jetpacks. I mean, it's getting real.
I'm just saying there's got to be other ways. It's probably misunderstanding, whatever's going on, because there's so much other stuff.
Well, I hope so.
Yeah, I hope so too.
And I hope they continue to raise rates and we can make fighting wars too expensive to engage in, right? Because that's definitely, that's something that, well, I mean, it is too expensive. It's only when you're not considering the full cost and you're only looking at it through monetary lens, and then it's, it becomes a financial decision. But when you really look at it, yeah, it's too expensive, no matter what the finance is, right? And so getting out of that loop, getting out of that trap is a win, however it happens, right?
I dig it. I agree. I'm just thinking Swan Lake, Nutcracker.
Yeah.
I got Tchaikovsky now on the mind.
That's funny. Well, I brought up Austria.
I'm gonna have to jam it. So, okay.
Blue Danube.
This is so long term. We're saying the next year, we're going to see some rate hikes, obviously.
Yeah.
And the markets will reflect. But after that, I mean, the expectation is it may be sooner.
Could be sooner. Yeah.
Could be sooner, but sometime around 2023, within a year, we'll watch to see that easy money policy return. Continue.
Yeah. So getting from here to there would, stable coins could be, this might be the time to go to the risk off strategies, the anchor 19%, the whatever stable coin staking plays you do. This might be the time to start thinking along those lines, right? Moving some percentage of your holdings in that way, not financial advice, but that's what we're, that's kind of the game plan we're on.
Well, that's what we're talking about for sure.
Yep. Yeah.
And, or be ready to watch it all go down with a smile on your face and not wonder why is it going down. I have no idea why. Just
right. You'll
know. To watch it go down and just continue compounding those rewards on your stakes and continue accumulating those airdrops, because there are still opportunities when the markets go down. And if you're out, you're going to miss out on airdrop. You're going to miss out.
In fact, and I would go along with that and say, this is the opportunity. If people think that when crypto is pumping, that's the opportunity because that's when people are making money. But really, that's the opportunity has passed you by already. Right. This is the opportunity.
Over the next year, as you start seeing the things take place, do your research, find out those projects, protocols you want to participate in, support, and add value, because when those easy money policies return, there is some easy money.
Yes.
To,
buy valuable buy good quality, names doing sound work, and look for them on sale, right? That's the name of the game.
That's it.
Well, I think we covered that. If there's any questions or comments or criticisms, by all means, leave them in the comments. We would love to respond, and we'll be pumping these out as the news hits our feed, right? Because this seems to be the season of macro stories. So I feel like this series is gonna continue, and we're gonna have a lot of fun talking about this stuff. So
we've been waiting this moment for a little while.
Yeah, we've been preparing for this.
This is fun. To think about blockchain and crypto and with what's going on in the world. This is a perfect storm of subjects that we like to cover and talk about. We'll continue to share that. You know what to do if you like to hear it. Notification bell, subscribe, hit the like, and until the next time, have a beautiful day and namaste, y'all.
Thank you.